This morning, I would like to discuss the ubiquitous Bitcoin. It seems that of late, I cannot leave my home without some random stranger advising me on why I should invest in Bitcoin. Whether at the supermarket or at the gym, it seems as if every Trinidadian is investing part of their portfolio in Bitcoin. So let's dive into Bitcoin this morning and see what we could learn about this asset class.
Bitcoin was created in 2008 when a white paper entitled Bitcoin, a peer-to-peer electronic cash system, was published anonymously by either a person or a group of persons going by the pseudonym Satoshi Nakamoto. Bitcoin took aim at traditional finance, in which trust was a necessary ingredient for the system to function. In other words, for the traditional banking system to work and function seamlessly, the participants must have trust in the regulators, not to debase the currency. Banks must also be trusted to hold our deposits and to transfer them when instructed to do so. And customers must be able to trust the banks regarding the privacy of their assets. Bitcoin was seen and sold as a cheaper mechanism to facilitate financial transactions outside the ambit of traditional institutions and government's control, while only relying on the digital identities of the transacting parties. Over the past 10 years, Bitcoin's price has experienced dramatic growth and volatility. In 2014, one Bitcoin traded around $300 to $1,000. With the bull run in 2017, Bitcoin surged from around 1,000 in January to nearly 20,000 in December of that year. In 2018, the price of Bitcoin crashed, ending the year at around 3,000, thereafter recovering in 2019 to around 10,000. In the 2021 massive bull run, Bitcoin again hit an all-time high of 69,000 in November, falling back to 16,000 in 2022 in the wake of the collapse of FTX. Today, Bitcoin is experiencing its highest price, having surged in excess of $100,000 in the wake of the resounding electoral mandate provided to President Trump and his commitment to creating a regulatory environment more friendly to the regulation and promotion of all things crypto, including, of course, Bitcoin. What has accounted for these wild swings in the price of Bitcoin? Can Bitcoin achieve its stated goals? These are the issues which I would like to discuss today on my take on Bitcoin. Today, there's a debate as to whether or not Bitcoin is a currency or whether or not it's an asset, and what exactly drives its underlying value. If we say that Bitcoin is a currency, the question then arises, in whose credit and faith does Bitcoin stand? By its very definition, Bitcoin was intended as a medium of exchange that would facilitate the execution of financial transactions outside the ambit of traditional institutions and government. To the contrary, there's absolutely no currency in the world which does not enjoy the full faith and credit of the government who stands behind it. This is the nature of the US dollar, and it is the same for any other global currency. The value of these currencies and the confidence which consumers place in them is directly correlated to the confidence in which these same consumers have for the respective governments that stand behind these currencies. Bitcoin, therefore, is the very antithesis of a currency. From a practical and logistical standpoint, as a currency, Bitcoin is also quite problematic. A simple example can serve to illustrate this point. Currently, if a bank customer wants to transfer cash to a third party in order to facilitate a payment for an underlying transaction, that transfer can be easily accommodated by simply contacting one's bank and providing the wire details for the contracting party on the other side. In today's world, that transaction takes literally minutes and involves the payment of a small fee depending on the jurisdiction in which one operates. These transactions are seamless and inexpensive, and they're facilitated through a series of intermediaries, including, where international transactions are involved, correspondent banks. If for any reason the receiving party does not receive the funds in their account, they can easily contact the sender, who can then contact his or her bank and initiate a query, which is usually cleared up in a matter of hours. In any event, the point is that in the event that there is any misunderstanding whatsoever, there are actual parties that can be contacted whose primary role it is to resolve these issues. Interestingly, there is no such intermediary where transactions involving bitcoins are concerned. Because bitcoins are sent to an address and moreover sent directly to the intended recipient, in the event that the address punched in by the sender is incorrect, then the funds are gone forever. There's no one to check or verify or to call back for the funds. Using the same logic and the same line of argument, in the event that someone held a bank account and lost their online password, they could always contact their bank and through a number of simple steps have a new password issued and validated so that they can regain access to their online account. Not so with bitcoins. Bitcoins are currently held in digital wallets, with each owner having a password to access his wallet. If, for any reason, the owner loses or misplaces his wallet, or is unable to recall his password, those bitcoins which were sent inadvertently will be lost forever. Interestingly enough, this is exactly what happened several years ago when the CEO of Quadriga, a Canadian crypto exchange, died suddenly while on vacation in India. The company could not pay back $250 million investor funds, as only the deceased executive knew the security key passwords, without which no one could access the coins. Another important point that should be highlighted and understood is a very limited role which Bitcoin actually plays in day-to-day commercial transactions. Whilst most commercial transactions today are concluded and finalized in terms of payments using cash, credit cards, or mobile wallets, less than 0.1% of global economic activity is actually conducted using Bitcoin as a medium of exchange. Something to take note of. I turn now to Bitcoin's utility as an asset. All assets, whether they be financial or real, stocks, shares, real estate, or gold, have one of three underlying principal qualities and characteristics. Assets have the capacity to grow or fall in value, depending on the fundamentals of the economy. They have the capacity to generate income, which can then be used to pay dividends, or they have some intrinsic value which can be applied to industrial or aesthetic use. Bitcoin, for all of its boast, possesses none of these attributes. To further compound the problem, Bitcoin is not a corporate entity. It has no shareholders. It has neither a balance sheet nor an income statement. Importantly, there are no cash flows emanating from Bitcoin. Bitcoin will therefore never be able to pay a dividend. Lest it be said that the same can be said for gold, silver, and other precious metals, which, apart from being commodities in themselves, can also be classified as financial assets. It's important to note that these precious metals all have industrial applications. Gold, for instance, has a wide range of industrial applications due to its unique properties such as conductivity, corrosion resistance, and its malleability. Gold is also used in satellite circuitry and as a radiation shield. Gold is also biocompatible, making it ideal for pacemakers, stents, and dental work. The same may be said for silver. It has a wide range of industrial applications due to its excellent electrical conductivity, thermal conductivity, reflectivity, and antimicrobial properties. While blockchain, the platform which Bitcoin runs on, has industrial application in the sphere of finance, which may improve over time, Bitcoin does not. Bitcoin itself does not. In the case of Bitcoin, therefore, there is no real asset, there is no business or business model per se behind Bitcoin which is generating cash flow or income, and there's absolutely no ability whatsoever to pay a dividend. Another interesting dimension regarding Bitcoin is the fact that there is an absolute cap on the amount of Bitcoins which will ever be in circulation. That figure is 21 million coins. If one can imagine for a second an economy in which Bitcoin is the only currency and medium of exchange, with this cap on the amount of Bitcoins that will ever be in circulation, one can easily see how Bitcoins may create a deflationary spiral. With the amount of Bitcoins in circulation capped and the economy growing, the price of Bitcoins will have to drop to equilibrate with the increase in production. In an interesting twist, even the anonymity initially promised by Bitcoin has been elusive. While Bitcoin addresses are not directly linked to personal identities, all transactions are recorded on the public blockchain, meaning that anyone can analyze the flow of funds. So, I go back to my original question. What exactly has been driving the price of Bitcoin over the past 10 years? Quite simply, speculation, greed, ignorance, and market liquidity. Something to think about. A word to the wise.